Hi and welcome to another trading video from xChief. In this video, we'll delve into the Consumer Price Index, explaining what it is and why it is so important for traders to understand. Let's get to it. Firstly, let's talk about what the CPI is. The CPI is one of the most important economic indicators. It tracks the changes in prices of a basket of goods and services over time, giving us insight into inflation and the purchasing power of consumers. The basket includes everyday items like food, clothing, housing, and healthcare. There's also something called the core CPI, which excludes volatile items like food and energy, giving a clearer picture of inflation trends without the distractions of the price fluctuations. Now, the CPI reports are regularly published by governments to provide insight into the economy. These reports detail price changes across various sectors, helping economists and policymakers make informed decisions. For example, in the US, the Bureau of Labor Statistics releases the CPI report monthly, which it has been doing since 1913. Other countries like Australia and Germany have their own CPI schedules, with reports coming out quarterly or annually. So, what does CPI mean for Forex? CPI directly impacts the currency markets. When it rises, it signals inflation, which typically weakens a currency. To control this, central banks often raise interest rates, making the currency more attractive to investors, which strengthens it. On the flip side, when CPI drops, there is deflation, and central banks may lower interest rates, which can reduce demand for the currency, making it weaker. Now let's focus on the US dollar and the CPI. When the CPI increases, the dollar often strengthens because investors expect the Federal Reserve to raise interest rates, which makes the dollar more appealing. At the same time, rising inflation can lead investors to turn to gold. Gold is often seen as a safe haven asset during uncertain times, so when inflation rises, gold prices typically go up as investors look for ways to protect their wealth. But how exactly do you trade with all of this information? The key takeaway is that CPI news often lead to market volatility, which means preparation is essential. Before the report is released, take time to review market forecasts and set your strategy in place. It is also important to implement strong risk management and set clear stop loss, as well as take profit levels to protect your position. Once the report is out, remember that the initial market reaction may not always be reliable. Instead of jumping on the first movement, stay patient and follow the broader trend. To stay ahead of the game, track CPI release times using an economic calendar and combine technical and fundamental analysis to make informed decisions. Always remember to manage your capital wisely to minimize risk exposure. In summary, understanding how CPI affects Forex trading can give you an advantage in the market. Whether you're trading the US dollar, gold, or other currencies, being aware of CPI reports can help you anticipate market movements and make smarter trading decisions. That's it for today. Thank you very much for listening and learning with me. If you already use CPI in your trading, please show us all how to integrate CPI into your approach in the comments below. And if you found this video helpful, don't forget to subscribe for more trading insights. Thank you and good trading.